Imagine owning a small piece of Apple, Tesla, or Amazon. Every time someone buys an iPhone or orders something online, you'd earn a tiny fraction of that money. This isn't fantasy. It's exactly what happens when you invest in the stock market. Welcome to the place where everyday people become owners of the world's most powerful companies. The stock market has created more wealth for more people than perhaps any other institution in history. Yet for many, it remains shrouded in mystery. Today, we're pulling back the curtain on this wealth-building machine and showing you how it can help build your financial future. A stock represents actual ownership in a company. When you buy even one share of Apple, you literally own a tiny piece of the entire business. This concept dates back to 1602, when the Dutch East India Company became the first business to sell shares to the public. Ship voyages to Asia were profitable but risky, so selling shares allowed the company to raise money from many investors. Stock ownership comes with rights. Shareholders can vote on important company decisions and receive dividends, portions of company profits. But the true power of stocks comes from capital appreciation, the increase in share price over time as businesses grow. Every publicly traded company started as a private business. The process of selling shares to the public is called an initial public offering, or IPO. Consider Facebook's journey. Mark Zuckerberg started the company in his Harvard dorm room in 2004. In 2012, Facebook conducted its IPO, allowing the public to buy shares for the first time. The company raised over $16 billion in a single day, providing enormous capital for growth. Today, anyone with as little as $200 can become a partial owner of Meta by buying a single share. This transformation happens through investment banks that help determine the initial share price and find buyers for the first shares, a formal introduction of a company to the public markets. Stock exchanges are the organized marketplaces where buyers and sellers meet. The New York Stock Exchange, founded in 1792, began with just 24 stockbrokers signing an agreement under a buttonwood tree on Wall Street. Today, it's the world's largest exchange. While the NYSE still maintains a physical trading floor, most trading happens electronically through vast computer networks, processing millions of trades per second. Other major exchanges include the NASDAQ, the Tokyo Stock Exchange, and the London Stock Exchange. When you press buy on your investing app, sophisticated algorithms match your order with someone looking to sell, often executing the trade in milliseconds. Stock prices are determined purely by supply and demand, what buyers are willing to pay, and what sellers are willing to accept. This constant negotiation creates price movements. The crash of 1929 provides a sobering example of this dynamic. As panic spread, virtually everyone wanted to sell, and almost no one wanted to buy. With supply vastly outstripping demand, prices collapsed by nearly 90%. The stock market is a complex ecosystem of different participants with different goals. Individual investors might be buying for retirement or to build wealth gradually. They typically hold investments for years or decades. Institutional investors like pension funds manage enormous sums for thousands or millions of beneficiaries. CalPERS, the California Public Employees Retirement System, manages over $400 billion in assets. Professional traders might be looking to profit from tiny price discrepancies that exist for just seconds, executing thousands of trades per minute. Companies themselves participate by buying back their own shares or issuing new ones. Apple has spent over $550 billion buying back its own stock since 2012. Following every individual stock would be overwhelming, which is why we have market indexes, baskets of stocks representing a segment of the market. The S&P 500 tracks 500 of America's largest companies. When someone asks, "How's the market doing?" they're usually referring to indexes like the S&P 500, the Dow Jones Industrial Average, or the NASDAQ Composite. In 1976, John Bogle launched the first index fund for individual investors, allowing ordinary people to buy the entire market with a single purchase. This innovation dramatically reduced costs and democratized investing. Today, anyone can invest in thousands of companies simultaneously for virtually no cost. The true power of the stock market lies in compounding, what Einstein reportedly called the eighth wonder of the world. Compound returns occur when your investment earnings begin generating their own returns. Invest $1,000 that earns 10%, and you'll have $1,100. The next year, you're earning returns on $1,100, not just your original $1,000. This snowball effect becomes extraordinary over time. A powerful example, $100 invested in Coca-Cola when it went public in 1919 would be worth over $10 million today, at the S&P 500's historical average return of about 10%. Money doubles approximately every 7 years. Warren Buffett's wealth demonstrates this principle in action. Over 90% of his $100+ billion fortune accumulated after age 65, not because he suddenly improved as an investor, but because his earlier investments reached a compounding tipping point. Markets move in cycles, periods of optimism called bull markets and periods of pessimism called bear markets. The bull market from 2009 to 2020 saw the S&P 500 increase by over 400% as the economy recovered from the Great Recession. Companies like Netflix saw their shares rise by over 6,000% during this period. Bear markets, like the one triggered by the 2008 financial crisis, can see indexes fall 20%, 30%, or even 50%. These declines are painful, but have historically been temporary, with markets eventually recovering and reaching new highs. Understanding that markets naturally cycle between optimism and pessimism helps investors maintain perspective during volatile periods. After the 1929 crash, the government created the Securities and Exchange Commission (SEC) to protect investors and maintain fair markets. Today, companies must disclose extensive financial information, insider trading is illegal, and market manipulation carries severe penalties. These regulations don't prevent all problems, but they create a more transparent environment than existed in the past. While some view regulations as burdensome, history shows that markets function best with clear rules, ensuring transparency and fairness. With today's technology, investing has never been more accessible. Most online brokers offer commission-free trading, and you can open an account with just a few dollars. The key to successful investing isn't finding the next Amazon or timing market movements. It's consistently investing in a diversified portfolio aligned with your goals and time horizon, allowing the miracle of compounding to work in your favor. Index funds provide instant diversification across hundreds or thousands of companies. A simple portfolio of broad market index funds has outperformed most professional investors over long periods while requiring minimal knowledge and effort. Warren Buffett has instructed that after his death, his wife's inheritance should be invested 90% in an S&P 500 index fund and 10% in government bonds, a strategy worth considering for your own investments. Emotional decision-making, panic selling during market declines, or excitedly buying at market peaks typically leads to poor outcomes. During the 2020 COVID crash, many investors sold at the bottom in March, only to miss the rapid recovery that followed. Attempting to time the market rarely works consistently. Studies show that missing just the 10 best days in the market over a 20-year period can cut your returns in half. The antidote is a disciplined long-term approach focused on your financial goals rather than short-term market movements. The stock market's fundamental purpose is connecting businesses that need capital with people who have money to invest. This system has funded innovation, created jobs, and built wealth for generations. While markets will always experience volatility, their long-term trajectory has consistently been upward as human innovation and economic growth continue. Every dollar invested in the S&P 500 in 1957 would be worth over $210 today, even after accounting for inflation. Successful investing doesn't require predicting the future. It requires patience, discipline, and understanding that you're becoming an owner of real businesses that create real value in the world. Remember that time in the market beats timing the market, and the greatest asset you have is your ability to stay the course through market cycles. Until next time, this is the Wealth Squad, and don't forget to get money, buy income. If you found value in this video, hit that like button, subscribe to our channel for more financial wisdom, and drop a comment below with your stock market questions or experiences.